Welcome back, traders. The time is upon us once again. It's Friday, April 30th, 2021, and this is the big picture where we go over the central themes driving the financial markets and put it all together in a way that makes sense. Lots to talk about today. As always, we'll end with some action items and with some thoughts on what to look out for next week. So without further ado, let's jump in. I'll see you on the other side. This week's overarching narrative was monetary policy. On Wednesday, we got some Fed speak from Fed Reserve Chairman Jerome Powell, our man Jay Powell, right? He was saying that the Fed will not be tapering bond purchases, which effectively extends the accommodative monetary policy, and that should continue to support economic growth. So I want to get into that a little bit and kind of talk about where we are in currently with monetary policy, where we're coming from and where we're likely to go next. So on Wednesday, Jay Powell reiterated that the Fed's main focus is still its dual mandate, right? That being promoting price stability and maximum employment. So that's known as the dual mandate of the Federal Reserve. There are two main objectives, and effectively what the aim of all monetary policy is towards. So recently the narrative has been that with all the fiscal and monetary stimulus, the market's getting nervous about hyperinflation, or at least increased inflation that requires the Federal Reserve to raise short-term interest rates, which obviously would have a cascade effect on the financial markets. So reiterating on Wednesday that the Fed's main focus is their dual mandate and that they're not concerned yet about runaway inflation, it tells us that for now, at least for the next couple of months, the Fed's not likely to change monetary policy until they see a full economic recovery. How are they going to measure that? Well, again, on Wednesday, Powell was saying that essentially he'd want to see sequential employment gains. So several months of steady improvement in the labor market and improvement in the employment outlook. So, that's going to be the main measure that we want to look at, and the tool that we're going to use to gauge whether we can expect changes in monetary policy and the likely implication that that's going to have on the markets, right? So I'll be checking in on the unemployment level, initial jobless claims, all the employment related data that we have here in the bear matrix, and we'll talk about those things each week here in the big picture, keep tabs on them, and make note of the likely effect that changes in that data will have on monetary policy looking forward. Additionally, we'll want to keep looking at economic growth data as well. It's becoming pretty clear that the main underlying narrative that the Fed is thinking about is the economic recovery still in play? Right now, absolutely it is. All the economic data coming out is resoundingly positive. We have, once again, those easy year-over-year comparisons. So as long as that continues, the employment picture continues to improve, we can expect changing monetary policy here in the next several months. But for now, it's all systems go. The Fed continues to signal its support of the economy by way of easy money policies. Powell continues to make it clear that he's more concerned with ensuring the economic recovery than he is about, runaway inflation. Now, before we move on, I want to talk a little bit about the monetary policy tools that the Fed has deployed so far since the beginning of the pandemic. So since the beginning, the Fed has stepped in with several variations of monetary support. First of all was the introduction of special purpose vehicles. There was the reduction of the supplemental leverage ratios. We have this asset purchasing program and obviously lowered interest rates. So some of this stuff is more commonly talked about. Others are a little more advanced and kind of in the woods, right? So namely the special purpose vehicles and the reduction of the supplemental leverage ratios. I don't want to go too deep into either of those things here, but definitely good further reading if you want to deepen your understanding about the tools of monetary policy that the Fed is deploying. But know that thus far, the special purpose vehicles and the reduction of the supplemental leverage ratios have already expired. So those two bits of the monetary policy puzzle, right? Those tools that the Fed has used to support the economy, they've already let those lapse. So those are two tools that now the Fed has back in their arsenal. If the economy continues to struggle, they could re-implement those things. And that would be the idea with the rest of those tools too. I mean, they don't want to constantly support the economy in needless ways, because if the economy turns south again, they want to have tools that they can deploy once again to help support the economy. So what's still happening right now? We still have this asset purchasing program, and we still have near rock bottom interest rates. So the one that's in question right now that we've been talking about is this asset purchasing program. So what does that mean exactly, and why does it matter? Well, essentially, it means that the Federal Reserve is buying U.S. government treasuries. And that in and of itself means that the Federal Reserve is lending money to the government, okay? So when they buy U.S. treasuries themselves are just government debt. And the government raises that debt so that they can distribute money in all kinds of different ways. So the Federal Reserve doesn't just take money out of its own piggy bank and give it to the government. I mean, essentially it just makes a ledger entry on its own balance sheet. So that's what they're talking about whenever you hear balance sheet expansion. It means that the Federal Reserve is taking US government debt, holding it on its balance sheet, effectively increasing the money supply. That's the key right there, is that, this asset purchasing program increases the money supply. That also has the effect of devaluing the dollar. So they're creating more money. They're not printing actual physical dollar bills and giving it to the government, but they're creating more money that the government can then turn around and distribute throughout the economy. Now, is the government doing that, and are they doing that effectively? That is another question, definitely needs an answer, and one for another video. So again, when the Fed purchases US Treasuries, it increases the money supply. When you increase the money supply, it means that each unit of the money is worth less. So that's why we've seen this big decline in the value of the dollar since the pandemic has begun, because there's more dollars, so each dollar is worth less. Now, again, you get the dollar right, you get a lot of things right. As the dollar has devalued, it costs more. It requires more of those same dollars to purchase the same amount of physical goods, namely commodities like oil, lumber has been in the news lately, steel, corn and wheat popped way higher this week. So all of those commodities in particular are priced in dollars. So as the value of the dollar has gone down, it requires more of them to purchase those physical goods. Think about lumber has absolutely gone parabolic recently because, again, the dollar is worth less, requires more of them to purchase lumber, so the price of lumber goes up. The input of lumber into other things, namely housing, goes up, right? So we've seen soaring housing prices. So something like monetary policy involving asset purchases trickles all the way down to the increase of the value of your home. So thinking in this way, thinking about the cascade effect that these monetary policies have can really inform your trading and let you know about what the central themes are and what's likely to happen next. So what happens if they stop this asset purchasing program? Well, number one, there's going to be less money being distributed through the economy. The money supply growth rate will cease to increase as exponentially as it has, right? So that's one thing. There'll be less liquidity in the market, or at least less new liquidity in the market. Okay, so also, the persistent devaluing of the dollar that we've seen over the last 13 or 14 months now wouldn't have so much downward pressure. It doesn't necessarily mean that the dollar is going to pop higher all of a sudden, but without that downward pressure, the current upward pressures on the dollar are going to be met with less resistance, right? And there are certainly upward pressures on the dollar right now, namely the fact that, while U.S. yields are generally pretty low, we're relatively attractive next to the rest of the world. I mean, the rest of the world, for the most part, has negative nominal yields. The U.S. is one of the few developed countries that still has positive nominal yields, right? So the relative attractiveness of U.S. yields is appealing to holders of foreign currencies. So when holders of foreign currencies exchange their currencies for dollars so that they can chase U.S. yields, that increases demand for the dollar. That puts upward pressure on the price of the dollar. So ending the asset purchasing program could be a tailwind for the dollar. And what happens if the dollar gains strength? Well, if the dollar gains strength, that's going to put downward pressure on commodities prices, right? And there's a couple of tailwinds that commodities prices have right now. First, we have the weakening dollar, which we just talked about. Also, we have this kind of supply chain disruption because of the pandemic. It's been harder to move things around, right? It's been harder to move physical goods around. So that's been another upward pressure on the price of commodities. But as vaccinations continue to roll out and coronavirus, the pandemic subsides, those supply chains are opening back up. So that would be another downward pressure on commodities prices. So then we have these two big pressures, what were two tailwinds for the price of commodities, now two headwinds for the price of commodities, pushes the price of real goods down. That's extremely deflationary. Reduced commodities prices would reduce expectations of inflation moving forward, would reduce yields, which would make financials, particularly banks, less profitable. So all of these implications, this cascade effect, all coming back to monetary policy. So we're doing a lot of second level thinking today, playing out scenarios, what ifs, thought experiments, but this is the kind of thinking that I like to do, connecting these dots, considering the implications of changes in things like monetary policy can really help inform your investing and tune you into the central themes at play and what's likely to happen next, right? So again, we'll be looking at economic data to get an idea of what's likely to happen next with monetary policy, because that's likely to tell us what's going to happen next in the markets and how we should allocate our portfolios to position ourselves to be ready for any changes in that regard. Now, this is only one set of important circumstances that can change. I mean, last week, if you watched the big picture, we talked pretty expansively about the new infrastructure plan and other fiscal policy. Now, that's going to have implications all of its own. So important to be thinking about all of these things, connecting all of these dots. So keep up with the big picture where we're talking about this stuff all the time, and I'll clue you in as to what I'm thinking about and what I think is important week by week. The fourth and final tool that the Federal Reserve has deployed to support the economy since the pandemic is obviously interest rates. The first thing they did was lower interest rates. It's likely the last thing they'll do as we come into the economic recovery is begin to hike interest rates again. Now, specifically, the Fed has control over the Fed funds rate, which is the very short end of the yield curve. So the Fed funds rate is the overnight rate at which banks lend money to each other. Currently, the Fed funds rate is at 25 basis points, right? 0.25%. Now, that's historically extremely low and leaves very little room for the Fed to lower interest rates any more than they already have. I mean, they can go zero, they can go negative, but it's not likely that the Federal Reserve is going to implement negative interest rate policies here in the United States, but it's not impossible. All that said, Powell has come out saying that he's not going to hike interest rates until once again he's sure about the economic recovery till employment data has improved sequentially, until there's economic data growth. So this is going to be the last thing that they do, and most analysts' estimates don't see interest rate hikes till 2022, 2023, even 2024. So unless we see significant and persistent inflation, it's not likely that the Fed's going to raise the Fed funds rate anytime soon. But eventually the Fed will need to raise interest rates because they'll want to prepare themselves for the eventual next economic downturn. They want to have a healthy Fed funds rate that they could reduce given an economic downturn in the future. So eventually we'll see the Fed hike rates once again, but again, not until they're insured of the economic recovery and until Powell knows for sure that the economy is standing on its own 2 feet. So monetary policy, lots to be thinking about. Huge implications for the financial markets. So we'll keep tabs on this stuff and we'll keep talking about it in the big picture. Moving on. Looking at the current macro trends, we'll start with U.S. equities, up across all time frames, long-term, mid-term, near-term uptrends. Let's take a quick look at some of the broad market indices here. We're in the bear matrix in the overview watch list here on the market watch tab. So let's have a look. Let's see, S&P 500. As of Thursday's close, was up 0.5% yesterday, up about, just shy of 2% on the week, 6.5% on the month. So, again, up across all time frames. Currently, range rank of 87% tells us that we're towards the upper end of the short-term range. So, more downside than upside in the near term. If we look behind me here, we also see the vol rank of 10%. So, volume still suppressed and the market broadly. So right now all systems go in the S&P 500. Looking to the NASDAQ, it's about lunchtime here on Friday, currently trading down about 0.75, about 0.75%. So up 0.5% yesterday, up about 1.5% over the last week, trailing week that is. 8.2 on the month, so looking great in the NASDAQ as well. Again, vol rank suppressed here at 17% and range rank 69%. Tells us we're closer to the top than the bottom, more downside than upside here in the near term, but not at an extreme level by any means. It's a similar story in the Russell, feeling a little more pain there today, down a little more than 1% here, again Friday lunchtime. Let me get this up a little for you guys. Down 0.5% yesterday. So a 2-day decline shaping up here in small caps, but up on the week, up on the month, up in the midterm, long term. Still relatively low vol rank. Let's do this here. Yeah, relatively low vol rank, higher in its range. So not surprised to see this kind of 2-day decline here in the Russell, as we're just finding resistance at the top end of the range there, getting relief of kind of overbought near-term conditions there in the Russell 2000. So equities broadly looking good. Let's cruise down to the sector rotation study, just see how they've performed this week. I mean, virtually everything up except for the defensive stocks, healthcare, utilities, staples. So, that's what we'd want to see in a healthy market. Energy really taking leadership this week. So we'll come back to this when we talk about the sector rotations here in a minute. For now, let's cruise back to the current macro trends. So we got the US dollar as well, still in this long-term downtrend, mid-term consolidation, and this near-term move starting to look like a pretty solid decline. So let's take a closer look at that. So the long-term downtrend, pretty apparent here. As we zoom in, we see the intermediate term I'm thinking of right now as kind of around the beginning of the year. We see this this consolidation phase where we moved up, we moved down, which basically amounted to a big wash, right? We had some dollar strength here starting at the end of February towards the beginning of April, rather, this big move up, and then just right after that, this huge move down all through April. So we've seen a little more volatility in the dollar these last couple months, and with this recent big push lower, I mean, we reached the low end of the range. We're getting this little pop higher today, so Does it edge higher from here off the low end of its range? If it does, it would mean that this recent low is actually another higher low in this series of higher lows. So an interesting thing to note, yes, the dollar has been very weak this month, all through April. Extreme weakness in the dollar. I mean, moving down nearly every day. This midterm consolidation, though, looking more and more like strength in the dollar. So what happens next? That's a really important question to be thinking about, because again, like I always say, you get the dollar right, you get a lot of things right. So something to definitely be keeping tabs on still. And we talked at length earlier about how monetary policy is likely to affect the dollar moving forward. So for now, easy money policies are still in place for at least several months. So I think there's going to be more downward pressure on the dollar than there is going to be upward pressure on the dollar. Again, that can change here in the next couple months, especially if we see continued improvement in the employment picture. So I'm thinking that today's pop higher is more relief of oversold conditions, finding support at the bottom end of the range. So I'm still of the opinion that the dollar is not ready to rocket higher because of the downward pressure from monetary policy. But time will tell. Definitely something to be thinking about. Next up, we got 10-year yields still in long-term, mid-term uptrends. The near-term downtrend, but a pop higher this week. So let's take a closer look at that. Moving back up to the intermarket picture here. We got the 10-year yield. I mean, here's the pandemic fallout where yields dropped dramatically. We consolidated for a few months, moved into the long-term and mid-term uptrends. We can see that we've pulled back here off the top end of the range in yields. Let's drill a little closer. There it goes. As we zoom into the very near term, we see, we kind of hit a peak. We've been consolidating, moving sideways since mid-March or so. Had been hanging around near the low of the range and popping higher this week, back up to 164, range rank of 61%. So it tells us we're more or less right in the middle of the range. So my perspective on the near term is that yields have been pretty reactionary to commodities prices, and commodities prices have been pretty reactionary to Fed speak. Yields had spiked a lot higher on commodity strength, which was on dollar weakness, right? Jerome Powell came out once again on Wednesday saying that accommodative monetary policy is likely to continue for the next several months. So while yields had taken a breather off the top end of their range after spiking higher, that essentially told the market that for now there's still going to be downward pressure on the dollar. That's going to continue to support commodities. Increased commodities prices is going to continue to increase investors' expectations of inflation moving forward. That is giving a little tailwind to yields here in the near term. So we're seeing the spike higher as of yesterday's close. Here we are still around lunchtime Friday. Yields down about 0.6%, so still right there in the middle of the range. Today's move specifically looking like a reaction to today's down move in commodities. So let's take a closer look at that. Long-term, mid-term uptrends again here in commodities. Near-term uptrend as well, popping substantially higher this week, although we're back down a little bit today. So let's have a look there. Let's cruise up to the watch list here. We'll take a look at the commodities watch list. So I went ahead and sorted this on the 1 week percent gain. That's trailing 5 trading days, right? So Bloomberg crude oil, obviously a big steel, gas, natural gas, rare earths, copper, uranium, everything up this week. Having a great month, having a great midterm, long term as well. So that's moved most commodities up towards the top end of their range. We see some high numbers here in the range rank column. Volatility also still relatively suppressed. So vol rank here, most of these numbers below 20 or 30% here. So, all systems go here in commodities. Again, this pop higher in commodities has led to this recent pop higher in yields once again, moving yields, the 10-year yield back to the middle of its range. So here we are, still midday Friday. Commodities down a little bit today, taking a breather from this near-term up move. Oil oil specifically down like 2.2% today. What else did I see? Energy also off 2% today. So taking a quick breather from the near-term strength, the very near-term strength, right? This 1 week strength. So we'll see how these things play out, but it looks like for now that once again, Powell's talk on Wednesday told us that we can expect continued easy money policies. That would imply that we could expect continued weakness in the dollar, continued strength in commodities, so on and so forth. That narrative tells itself at this point. But I'd expect to see continued strength in commodities. Let's take a closer look at oil itself before we move on. I'm going to come down to our trading view technical analysis tool here. Yeah, so we see oil's long-term uptrend here, pretty clear, pulling back towards March or so 2020. As we zoom in, we see we hit that peak in early March or so. A quick correction and consolidation is where we've been since then, until really this week, where we finally kind of popped higher towards the top end of its range. Finding resistance there yesterday, again down today, but so far, and it's about 12:30 right now on Friday, we're on reduced volume and only slightly increased volatility. So it's looking like today's down move is more a product of finding resistance at the top of the near-term range. The question I'm looking to answer is, are we going to be able to pop above the recent all-time high, right? The recent cycle high, that is. So, back on March 11th, it looks like we kind of reached that peak that we corrected from and consolidated after that. So we got really close to that level yesterday, correcting from there. Are we going to be able to push above that cycle high? If we do, I think that oil is likely to continue higher from there. So again, this consolidation move was on down volume, on down volatility. So the lack of a volatility and volume spike on today's down move gives me more conviction, or at least that there's higher probability that after we digest this most recent move higher, that oil is likely to push higher, especially given the narrative of a likely continued weakness in the dollar, right? So that's what I'm thinking about as far as oil. We'll see how it plays out. With all that in mind, let's take a closer look at the sector rotations this week. So with this big push higher in oil this week, we also saw energy doing really well, taking market leadership here in the 1 week return. The near term for energy, not looking that great. I mean, towards the bottom of the pack here on the 1 month return. But energy here in the intermediate term, 3 month and 6 month, again in the market leadership position, and in the long term, down here again on the bottom half of the pack. So mixed messages from energy. Energy volatile as usual. It's a blend of fundamental driving factors of supply and demand, as well as the relative strength or weakness of the dollar. So a lot to be thinking about and watching in energy. Again, the move today lower in oil affecting energy. So this is 1 week return is likely to look different over the weekend as we get Friday's close data. But I'm still long energy for the most part, and this recent return to strength on the 1 week is giving me more conviction to press some of my longs, especially on today's weakness. So into the close today, I'll probably be regrossing on some of my energy positions. Financials also benefiting from this tick higher in yields. Communications has been interesting. Communications starting to show some new signs of strength here in the near term. Obviously doing well this week, doing well across the 1 month, towards the middle of the pack here in the 3 month and 6 month, and up here in the 12 month. So starting to see signs of life from communications again. Notably, at the bottom of the pack is staples, utilities, healthcare, so the defensive stocks. Last week, we had seen a rotation into defensive stocks, and these three sectors were the market leaders last week. But that rotation turned out to be just, more relief of overbought conditions in the other sectors of the market. So we got that 1 week counter trend move last week with the defensive defensive stocks taking leadership, and that counter trend reversing this week with staples, utilities, and healthcare defensives down near the bottom of the pack again. To me, that signals another all clear sign for the stock market broadly, especially when we consider Powell's comments this week and ongoing accommodative monetary policy. Overall reduced volatility levels. We didn't really look at that today, but still sub 20 in the VIX, so we're in the bulls bucket in that regard. We're still seeing positive economic data, positive and accelerating economic data coming out. In fact, we just got Q1 GDP out today. Look at that. January, this is actually quarter one, so it's telling you January 1st. It's actually through the end of March, so that's something I need to update in the software here. But obviously GDP trending the right direction and accelerating. 2.26% year over year rate of change, 7.14% year over year acceleration, up 2.5% sequentially. So GDP growth telling us really what we already knew. I mean, GDP is a lagging indicator. It looks back at what's already happened. We've been looking at some of the more current economic data and obviously keeping a close handle on prices, which has been telling us what GDP is really just confirming right now, that the economy is growing, the economic recovery is well positioned and in play. So all systems go as far as economic data as well. What to watch this week? The April sell-off in the US dollar to the low end of its range has been a tailwind for broad commodities. But the US dollar at the low end of its range creates a higher likelihood of a mean reversion next week. So a push higher in the dollar, finding support at the bottom end of its range, that will put downward pressure on commodities, which commodities are already at the top of their range, if you recall. So a lot of the individual components of the commodities, broad basket of commodities, pushing towards the top end of their range on strength this week. So I'm looking for a short-term pullback here in commodities with likely dollar strength and overbought conditions in commodities. So I'm still very bullish on commodities midterm, long-term. So if we do get a correction, that to me is going to be a great buying opportunity. So that's pretty well in line with the action items this week. I'll be reducing some exposure to commodities on a likely very near-term pullback, like as in next week. And if I do get that, I'll likely see it as another buying opportunity in the favorable mid and long-term uptrends. So I'll be looking closely to price volume volatility and the individual commodity components. I've been long copper, steel, uranium in particular. I'll be interested in buying opportunities in corn and wheat, especially given that we'll probably have several more months of continued devaluing of the dollar with the asset purchasing program continuing again for the next couple months. So I still like commodities, just not next week. Other than that, I'm looking a little closer at tech. We've had this 3-week consolidation after another push higher in tech. It's been on down volume, down volatility, so that looks like it might be primed to move higher. So I have a list of tech names that I like, and again, I'll be turning to price volume volatility in the last hour of trading today and into next week to be opportunity hunting. That's it for today, folks. As always, plenty to be thinking about and plenty of opportunity to be had. You guys like this video, hit that like button. Make sure to subscribe to the channel. Hit that little bell notification next to the subscribe button. That way, you'll get a notification anytime we release a new video. And for now, thanks for tuning in to The Big Picture, and I'll see you all next week.